Morning, market chameleons. Thanks for joining us on this lovely day. We are waiting for the King Chameleon, Dimitri Pargamonik. How you doing, Dima?
Good morning, Will. How are you?
Disclaimer's up. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. So what are we seeing this morning, my friend?
So I'm going to share my screen, and I think for today, we'll take some Q&A. I'm going to, and while we're waiting for that, I might just kind of show some features I am working on. They're not going to be available yet, but we talk. It's concerning the alerts that we're working on, but I might just take a couple of alerts from there just to show some examples of the analysis that still perform, but you just won't get it in an alert as of yet. So two ways to ask your questions, guys. You can put them in the chat. Will's monitoring the chat. He's going to read them back to me. Or, Will, you're putting a link in there to Zoom, right? And if somebody clicks over, that takes you over to Zoom. You raise your hand. We'll turn on your mic. This way we could hear the question live. You don't have to turn on your video camera, but then you could just ask the question directly.
Yep, links out there on the chat.
All right, sounds good. So while we're waiting for any questions to come up, Will, let's take a look at the pre-market report, and and then I'll move on to those alerts while we're waiting for questions to come in. Sound good? So this is the pre-market report. We got the most active stocks. These are stocks trading in a pre-market, biggest percentage gainers, biggest percentage decliners. I'm coming down here just to take a look at how many stocks made our percentage gainers list versus decliners. So we've got 215 stocks on the percentage gainers list, 52 on the percentage decliners list. So from that perspective, it looks like we're setting up right now for more bullish bias at the open. Let's filter out stocks that are in the S&P 500 to see if we see a similar situation. So I'm going to go here in ETF. I'm going to drop this down, and by selecting one of these ETFs, it's going to filter by the components or holdings in that ETF. So SPY, S&P 500. I'm going to click on that. So we see here, now we're only looking at S&P 500 stocks. 15 of those stocks made our percentage gainers list, one on the decliners list. So from that perspective, still, we're looking at a more bullish bias at the open. Like the lists aren't huge here, but 15 to 1. Any questions yet, Will, or should I move on?
Move on, my friend. No questions have popped up yet.
Okay. So I'm going to kind of come here because this is this thing that I'm working on right now. And keep in mind, you don't have access to this yet. I'm showing you on my internal page. And as I'm working on it, there are a lot of stuff in here that I have to do to work out bugs, test, check. So you don't have this available now, but it's actually, I think you guys are going to like it because internally right now, and I test a lot of features out, and this is like really, one of the things that I'm always going to. It's kind of like already becoming my favorite tool. So, you guys have some patience, but I wanted to show you just because, you might not get the alert, but you could still kind of perform the same analysis. Okay. So you kind of have to do the setup yourself, but you could perform the same analysis. So like over here, on the top one, it alerted me to a calendar put spread in Micron Technology, MU. Okay. So this is obviously from yesterday, we're not open yet. So this is using yesterday's prices. And this is actually a spread that it's straddling, I believe, the next earnings. Okay, so what it's doing is this is pointing out to me a calendar spread that we're buying an option that covers the earnings date and selling an option that's going to expire prior to the earnings date. And I'm going to click on this here, view on the options chain. And, so here are going to be the alerts. Here's kind of a short explanation. Then you click on it. So then it populates these legs, right? And then we're going to start kind of analyzing them. So let's just see what it did here. It told us on December 10th, right, expiration over here, selling the 69 put for 110, okay? And then buying the December 23rd put. So this is December 23rd. And you can see I'm hovering over that E. That's telling me that earnings are on December 20th. So you could see that December 23rd expiration, that's expiring after earnings, right? December 10th expiration, that's going to expire before earnings. So really the premiums in those two different expirations should reflect that, right? So the premium in December 23rd, the options premium should reflect that, hey, there's going to be an event. December 10th, that the premium is going to reflect that they're still trading in regular volatility, but we're not going to have this binary event. So the question is, though, even though we know that and we see that implied vol is higher December 23rd, it is lower December 10th, but we expect that, right? That's already expected because we know why. The question is, how do these options still line up versus each other? Does it present a good opportunity, an entry opportunity, potential opportunity, right? So that's the question, and what we're going to do is look at it from a historical perspective. Well, where are they usually priced versus each other? Okay, because if we could get a good deal buying one, good deal selling the other, it might present a good an opportunity there. So that's what we're going to be analyzing. That's what the alert is pointing to. Okay, so you could see here, this is how it's set up. December 23rd versus December 10th, and it picked the strike 69 strike. So you could change that, but I'm going to just hold on to that right now. But the strike is also important because that's kind of your target. Where do you think from today to December, to the first expiration, December 10th, where do you think the stock will float towards, right? Higher, lower? So that's going to play into it as well, but let's just leave it there for now. Okay, so I'm going to load the strategy, and this is what kind of like the graph looks like, payout diagram based on the first expiration, right? Because this strategy, in effect, it only exists till December 10th expiration. After that, December 10th, this option expires, so you don't have the same strategy anymore, right? It's either at that point you're going to have this call, and this December 10th call is either going to expire worthless or be in the money and be converted to stock. So this strategy itself, as a time spread, it's only good up till December 10th. After that, then it depends what you do, but you're going to have a different strategy on, right? Either you take it off or you're going to have something different on, because this option here will expire. Does everybody get that with the time spreads? And I get, the thing is, I do get a lot of requests about time spreads and diagonals, but I want to just make sure, there are a lot of differences between them and vertical spreads. So I'm just going to try to slowly walk through it. So I'm not hearing any questions, Will. I'm going to keep moving on.
Yeah, we do have some questions. Now, we don't, just so everyone knows, we don't send out any alerts at this time. This is something that is, like Demetrius said, it is in development, something he's working on. But someone was asking if, is it possible to get sent alerts if IV drops below a historical level? And that's kind of almost what you just showed, right?
Right. And that's kind of what we're doing here. I'm going to show you and that's how the alerts work. We're not sending them out. Like, we're not going to be, this, you have to be logged in to see the alerts, because they're going to be, right now they're not moving, because, this is only working during market hours right now. Okay. Sorry, we do have it stopping yesterday at 6:40, but during market hours, what you're going to see is that it's going to be updating. So right now it's not updating, right? It stopped since yesterday. So once the market's open and we're getting new analytics, I think it'll start in the pre-market actually. But once that's happening, it's going to be a feed. So it's going to be, it's going to kind of be moving kind of like your Twitter feed or Facebook feed, right? So it's not going to be scrolling so fast that you won't be able to read it, but it's going to be updating, I don't know, I forget what it is, maybe 30 seconds a minute, but it will be updating that way. So we're not going to be sending you, 100 alerts a day or whatever it is. But what it will be doing is something that we're testing out, and I'm kind of the test case, is it's going to try to alert you to things that it thinks you're more interested in. Okay, so kind of in the background, because the system can go and detect your watch list. It could detect, stock symbols that you're entering in, and it could detect that you're clicking on certain types of alerts more often than not. Like, for example, if you're clicking more on earnings, that the system will count that and put more weighting towards, okay, you're more interested in earnings than you are in, a certain different type of strategy, like, momentum stocks or whatever. So if you're clicking more on like maybe biotechs, it'll give that weighting. So yours will be a little bit different. And again, I'm testing it right now on myself, right? I don't have a big sampling right now to see how well it will work once we launch it, but that's the idea behind it. So your alerts will be a little bit more tailored to what the system is algorithmically thinking you're more interested in.
Now, for this new chameleon who asked the question, there is a spot you can go to screen for IVs that have made a move, right? Where it's either high IV or low IV compared to
you could do that now from a screener. It just won't, right? This will be more like an alert system, so you don't have to. The idea behind it is that you're not, you could always screen for things and analyze yourself, or you could get alerted to certain things that you might not be seeing that will just point you to it, right? So it'll just point.
It's going to be another spot to help you start your research and see if
it's like a starting point, right? Because when you're doing research, a lot of times you're looking for a starting point, or what's unusual. Where did something, diverge from a historical? And it was a good question. Where did something diverge from a historical mean where I could start looking, and why? But this is what
he's asking. Can you just show him where the screener is, or maybe take a look at the?
So, like, if you're just looking at, like, in general, IV rankings.
Yeah, IV rankings.
You could go here. You could go IV rankings. You could go to implied volatility movers. Over here is. Oops, sorry. Hold on a second. Under implied volatility movers over here. So I think under the stock screener, you could also screen by IV, but we have IV almost, referenced almost everywhere. Like even unusual option volume here, I'll go unusual option volume. Even here, you see the IV rankings, right? Percentile rank. So even where there's unusual volume. Okay, so, and anytime you go to a symbol here, let's go to Microsoft. If you're, you have the IV rank right here, 34th percentile rank, it's moderate. This is the IV.
And there are also a lot of videos, and I'm going to put a couple in the link so people can see them that you have done, D, that actually walks through people using the different IV screeners. So I'll put those out there.
Right. And I think it's just important to also why I'm doing these. That's how do you use IV? Like how do you use it to your advantage and to because remember when you're doing an IV rank, a 1 month, usually it's a 30-day IV, right? You're doing an IV rank. It's just to point you to something, right? Because the IV rank doesn't apply to every single, when you have one benchmark, like a 30-day IV, it doesn't apply to every option in every expiration. It's just telling you in general, implied volatility looks high in the stock or low. Then you got to go in there and do the analysis yourself for the individual options and what's going on and why is it high, are there, so an IV rank kind of just points you to a stock. It doesn't, you can't just use an IV rank and go in there and do an options trade, right? It's just pointing out something. It's kind of like saying, hey, you know what, the price of real estate prices went up in Pennsylvania, right? That's what it's doing. Then you got to go in there and say, okay, well, go to Pennsylvania. Where did they go up? Why did they go up? Was it in Philadelphia? Was it in Pittsburgh? Was it, so that's what the IV rank does. It's just a benchmark, right? And an IV rank is it's a calculation. It's not, some people think a stock has an implied volatility, but a stock does not have an implied volatility. Implied volatility comes from option prices, right? And option prices you put into a model to estimate the implied volatility of those options. Is that helpful? Hopefully.
Yeah, that was great. He said, thanks, great features.
Yeah. So I'm going to come back to this Micron, so let's take a look here. And a couple things we have to consider here. And I can't run a historical return distribution to get an estimated value of this spread because there's too many things going on here. There are different expirations. One expiration has an earnings, one expiration doesn't have an earnings. One expiration is going to expire, the other expiration is going to remain the same. Too much. So I can't run a distribution like we usually do, a historical distribution. I need to kind of then look at how the premiums measure up relative to each other now based on historical levels, right? So that's why I'm going to this IV Theo. And this is what the IV Theo is telling me. It's going back into our historical database, right? And we're continuously taking snapshots of the market, right? Then we have these historical snapshots going back in history. So I'm using 4 years. And what it's doing is saying, okay, now find all the situations that are similar to this. In other words, find me where, I have an option that's going to cover earnings and it's this many days from earnings and it's this many days from expiration. Then find me another, option where it's this far away from this expiration, but it expires before earnings. So basically it's going down in history and saying, find me a similar situation that I'm seeing today. Okay. So it's going back all these days in history that cover earnings. And then it's saying, then find me the strikes or the options, right, that are the same distance away as well. And, and how do those match up versus each other? So it's doing all this stuff to get you a similar situation. And then it's saying, all right, based on those, all right, so here's the historical dates. Based on those, tell me, if I used those snapshot implied vols and converted them to today's values, right? So to see here, option legs. So here's the explanation. Option leg 1, option leg 2, earnings, how many days away, and so forth. And then it's going through history and saying that these are the historical spread values. So on average, if we take on average all of them, it was 93 cents, right? So that's the average. Today we're looking at 84 cents, right? So here's the spread. Remember, it came back 84 cents, midpoint 77, bid 69. All right, so when we're putting on the spread, we want to get the best because you're purchasing it, right? So you want to get the best possible price. So 84 would be, you're just paying all the way, you're paying up basically just to get an immediate fill. That means like this spread is so good, I just want to get an immediate fill because the price is just like, I think I don't want it to run away from me. Or, you could sit there and probably say, well, I have plenty of opportunities here, and maybe if I could get this, at 70 cents, 75 cents, 73 cents, you might want to try doing that. But let's take a look here, come back here to the IBTO. And we see here that this is the range, high 121, low 66. So, we're below the average, right? Not at the very low, which might be okay. And we could see here, like, okay, below 84 cents, we see here, how many times it was below, how many times it was above in history, right? So these are the observations last 4 years. Now, keep in mind, we don't have 100 observations last 4 years because we have to spot earnings, right? In the last 4 years, it has to be around that earnings. See that? So here we see, it fell most of the time. I think right now it's set up that 70% of the I have to take a look. I think 70% of the observations historical had to be above the current price. But this kind of gives you, historical reference. Well, where am I getting it? How much am I paying? Your risk is how much you pay for it, and how far away it is from a historical mean, right? So then you kind of get an entry, a potential entry price. So the next thing we kind of want to know is, okay, now I kind of got an idea about my risk, right? My risk is what I pay for it, and I'm paying below this historical level. So that might be good. I could kind of see the high and low range. So you get an idea of like maybe placing your where to place a potential, purchase price. But then what we want to know is, well, what's my potential profit, right? I kind of got a sense of my risk here. What's my potential profit? Because if my potential profit's only like 10% or 20%, might not be worth it, right? So we kind of have to estimate the potential profit. The potential profit would be, first, depending where the stock goes. So in our best case scenario, at the first expiration, right? When this December 10th expiration, the stock goes right to the strikes. So 69 strike. But then what is this? If that happens, what do we think the spread will be worth, right? And how much profit potential is there, right? Is it even worth doing? Because if the profit potential is too small, maybe it's not even worth doing. So that's what we want to kind of take a look at. So I'm going to come here to the payout diagram. And this is already kind of setting minimums in the background, but I just want to show you how you can do the analysis now. So here's what the chart would look like on December 10th expiration. And what it's assuming here is the following: the December 10th expiration, the December 10th option, that'll be easy, right? It'll just be worth its intrinsic value. It's either going to be out of the money and worthless, or it's going to be in the money and worth whatever the amount it is in the money. But we don't know what the next option to expiration will be worth exactly. We have to estimate it because it's still going to have time premium, and that time premium is going to reflect that the earnings is still coming up, right? So how do we estimate that? Again, on December 10th, now we have a different scenario that, there's going to be that option left over with certain amount of days to expiration and certain amount of days to earnings. So we have to find that historically, we have to find that situation and see the implied volatilities or implied values for that option. All right. And, it's going to vary. So there's going to be a range. So here it's set to the 50th percentile. So it's going to pick the the midpoint value. Okay, the midpoint value, midpoint implied volatility. And we could see here that if I hover over it, that that the value of the spread, if the stock is at 69, it'll return $237 profit. That's your payout, $237 plus profit. So if you're paying 84 cents and making 237, that's a pretty good, what is that? I mean, over 200% return, whatever, but you could see here that it's a pretty good profit. I look more, really, you want to double, triple, quadruple, right? The more profit potential, the better. But I think it has a minimum right now of at least a double, maybe more, maybe a 200% return. But does that mean that that's your goal every time? No. What it's telling you, right, is that if you have a 300% potential profit with the spread, there's a lot of room, right? You have a lot of potential there, right? That, that's it could be 100%, 50%, but what you're doing is you're saying that there's a big room for profit, big potential profit. Is that making sense to people? Because some people will think like that means it's going there. No, that's just telling you, if I weigh my risk versus my potential, that there's a lot of room, right? Risk versus reward. Any questions there?
Not on that. No, we did have some questions about option order flow sentiment, but that may be a whole nother show.
Yeah. So here, look, I'm going to be moving, if I move it around, say, well, what if it's in the 30th percentile? Because I'm long this option. I could reload it on the 30th percentile, 223 over here. And you could see along the curve where it's profitable, where it's not. Obviously, if I give it 100th percentile at the highest, then you could see here much bigger, right? So you can move this around, but it's going to be defaulted to the 50th percentile. So look, it's just saying, what if it just reverted to the historical midpoint value? Order sentiment, I'm probably going to get to it, and that is another thing that I'm working on right now, and I'm going to improve that by a lot. But that will also be in January, and it's not quite, I don't even think I have it on this version because I have different internal versions, but we're performing more analytics on it to take into account a lot more than we are right now. So I think that that's going to be changing as well. So I think I'll start even talking about that maybe, in the coming up weeks. I could talk about what we
I did put the video relative to the report that exists now on option order flow sentiment. People were asking, how much does IV have to do with option order flow sentiment? Anyways, I put a link to your previous video on option order flow sentiment. Anyone who hasn't been to the YouTube channel, it is pretty useful. You can search by keywords, and I was able to pull it up. That video was made quite a while ago, but it's still there and has thousands of views. So it's a pretty useful tool, YouTube.
Yeah. So that it's a good question. We have something in there with the IV, but we're going in deeper now and really, as much as we can algorithmically detect what's actually going on, because sometimes an option will look like, hey, somebody is buying a lot, but it's actually somebody selling a lot. And to detect that, I'm going to show you ways to do that. Also, sometimes it looks like it's coming from retail, but it's actually not. It's a series of a much bigger trade. So when you're looking at the tape and when you're trying to figure out what's going on there, it takes a lot of analysis, and sometimes you can't even do it by the eye. You need a machine to help you out, and you need a machine to have all these different reference points and benchmarks to figure out what's going on. And that's what we're working on right now.
Awesome. Hey, D, we had one question from a new person who showed up, Jessica, this morning.
Yeah.
She's looking to see if there's any unusual option activity in symbols. Can you screen unusual option activity by symbols?
Well, you could go into here, unusual option volume.
She's looking at MU is one of them. Mike.
Well, if you just want to like put it in like this, you know, that it didn't hit our unusual option volume yesterday, but if you go to the stock screener, and then you can search
the symbol right there, right?
Yeah, this is the stock screener. So if you just wanted to go here are the options, right? Stock symbol options. And this is going to tell you the relative option volume, right? Microsoft, Apple. So if I just screen out MU like this, you know, oh, this is a universal search. So I think
it's there. It's popping
anything with MU. But
it's right there. It's fourth one down.
Oh, is it? Okay, there you go. So, you know, so here's the option volume, which is, you know, in its historical range, right? So 1 is like the average, right? So this is taking the option volume today divided by the daily average over the last 90 days. So this was below, this was yesterday, you know, it was 0.9. So you could kind of do it that way. You could screen by your, you know, by your watch list.
Yeah, and you can also screen, if you're on the unusual option volume page, you can actually screen by symbol too, if you want, in that same search function.
And you could set them here, you know, here, option volume, you know, you can do relative option volume. So here, give me unusual, like 3 times its average, you know, stuff like that. You can do it in here.
All right. Awesome job. Hopefully that helps, Jessica. Thanks for joining the Chameleon community and checking us out. Great job, Dima.
All right. Thanks, everyone, for joining. Stay safe out there. Have a good trading day. And we hope to see you tomorrow, right? We still have one tomorrow.
Yeah. One day left of the trading week. All right. Have a great trading day.
People were asking why we didn't do when Monday. I think Tuesday, right? Tuesday, we had to skip that show. There was a huge outage in Comcast, actually, that affected the internet, you know, here in Philadelphia. It was flaky, so we had to skip it that day.
That's why we weren't there.
I was getting a lot of emails for that. Yeah.
They love the show, D. They love the show.
Yeah.
All right, everyone. Thanks so much. Thanks for joining us. It doesn't work without the Chameleon community. Dima, awesome job. See everyone tomorrow.